we will have the fraud prevention in the bank sector, given by Adam Davies, VP Pro from FICO. So if you're interested in that one, stay here in room B. If you want to listen to the transition towards technological financial institutions, side A, the legal framework with Jose Diaz-Cuadra, the directive partner of legal and compliance advisors. So whichever presentation you're interested in, that's in room A. And then in room B, we will start with fraud prevention in the bank sector. So this is our speaker, an expert in fraud, security, and financial crime. He has experience in consulting in over 80 countries. During the last 23 years, his experience has been tested in multiple industries such as banking, telecommunications, retail, medical care, education and government, managing fraud, financial crime, operational risk, and internal fraud investigation. Considered an intellectual leader in entrepreneurial fraud with a history proven in providing customers with the best practices to minimize exposure, centralizing intelligence against fraud, and creating excellence centers against fraud. So, ladies and gentlemen, we're about to start. So I give you Adam Davies.
Thank you, Vicky, and thanks for joining us today to talk about managing fraud in a shifting banking landscape. I'm Adam Davies, Vice President of Fraud Protection and Compliance at FICO. So it's definitely interesting times that we're in terms of overall, how do we fight fraud in these changing times? And so there's a lot of shifts going on just generally within the banking industry and the payments industry. There's an explosion of data that's available to make decisions around. There's a lot of trialing and learning and experimentation in terms of new product offerings, new way to reach customers, with that backdrop of sort of digital transformation and digital payments. Everything that we do now needs to be much more real-time, engaging the consumers, understanding how to do all of that, but in an efficient way, right? Combining people, process, and technology, and you start to see again that human-machine collaboration where we have data science that's driving a lot of the decisions that we make. And then further, the kind of opening of banking generally, right? APIs and different parties in the value chain all connected together. And that's transforming the way we think about how we approach not only banking, but also how we approach things from a fraud and financial crime perspective. Because this becomes a rich breeding ground for fraudsters and scams and other such challenges. And so when we think about what's going on, there's also a lot of change in the threat landscape. So we're seeing increases in card not present, that digital enablement is driving up online and mobile banking losses. That comes with it a lot of scams and compromises. Again, we're seeing sort of changes in the dynamic of the physical nature of banking, right? A reduced amount of time in branches and at ATMs, and with that transformation has come a lot of peer-to-peer transfers and money movement, and a lot of the time that's irrecoverable. The form factor of the card itself moving to things like contactless, and in fact doing a lot of our business, not even touching the consumer, just enabling them through a digital channel, in fact even onboarding them through there. And a shift in the mix of the transactional spend that we see with our consumers. But it's become very challenging for the modern fraud manager because they have to maintain the controls on the prior frauds they've had for a long time, as well adapt to these new environments as they try and develop countermeasures for new types of frauds that we see coming. And so they're constantly balancing these balls in the air, right? Like we're trying to bring down our fraud losses, and often that means I have to work more cases and decline more. Yet at the same time, I'm trying to do less with less, right? So I have less people, perhaps. My budgets are being tightened. That means I can only work so many cases, or I need to spend less time on certain activities. At the same time as the control and expense on managing fraud, I'm also trying to make sure I don't do that too much, right? We're still here to make money, so I want to decline less. I need to increase acceptance or speed up the time it takes to onboard that new customer from a fraud perspective. But again, I have to balance that customer experience. And so reducing those false positives, trying to catch the fraud before the customer realizes they've become a victim, and making sure that irrespective of the product, I have the same authentication, the same fraud, the same sort of treatment of suspicious events. Not to mention the regulatory changes that we constantly face in the market. That means I've got to do model governance and change control and pass my regulatory audits, and that often takes more people. And finally, you know, how do we sort of stay on top of the reputational risk, right? The damage that can be occurred if we look like a bank or a financial institution that is prone to being attacked by fraud or can't protect its customers. Well, it's a difficult task to undertake, but one that can be solved with good combinations of technology, people, and process working together. So let's touch a little bit on the customer sentiment. And one of the things I'm quite excited about, and here I'm going to share with you some results from a survey we did actually in Mexico, is the customer sentiment and approach perhaps towards what may have traditionally been seen as frictionful fraud experiences are actually more adopted, or customers are more willing to adopt them than ever before. So let's just look at that kind of transformation, if you like, to digital. So the majority of the customers in Mexico now do want to establish that relationship from a digital standpoint. So about 67% are willing to open a credit card, 55% for a current account, 50% for a personal loan, actually completely digitally apply for that and fulfill that application. And they're expecting to be able to have to do things like scan a document or take a selfie of themselves or undertake some level of authentication in terms of opening that account. And when we think about proving who you are, right? So it's not about being in a branch and taking your ID out and showing it to somebody and then checking if that's you when you want to access your account or even open something. 69% are more than happy to prove their identity digitally. 48%, so nearly half, prove where they live digitally. And the thing that I'm quite excited about in moving forwards is biometrics. We've talked about them for a long time in the industry, but I think the customer adoption now with the regular use to open your phone with your face or your fingerprint, 47% of those people are happy to set up that biometric at their point of account opening and use it later on during their customer relationship. And some warnings, however, right? So if we don't fully embrace digital, and this is an example of some of the customer attitudes towards account opening, but if we don't, if we try to use some offline or traditional approaches with a new digital approach, it can be sort of damaging. So for example, I can complete most of the steps, but then I have to still go to a branch and show my ID, or I still have to take a photocopy of something and email it, or I have to PDF some documents or something like that. It can lose you business. So about 4% would give up completely, 17% would probably go to a completely digital competitor. You know, but half of those will eventually get round to maybe doing those extra steps that you've asked, but it's certainly not going to help accelerate onboarding those customers. So it's certainly interesting. And then from an account access perspective, so when we're trying to mitigate account takeovers and the abuse of those online channels, just relying on that password is just not good enough anymore, and customers feel the same way. So 78% are happy to provide their bank a biometric. 93% would be happy for the bank to analyze the way in which the password was entered. So a biometric layer, if you like, behind that passcode entry. And even further sort of things like a fingerprint, eye scan, facial scan, different biometric approaches people are becoming more adept to wanting. So some good signs from the consumers there in terms of their willingness to somewhat participate in those step up or those incremental authentication steps that we might want to take to prove their identity. But is there a new approach to risk that we should perhaps consider? So that's really the industry theme. I think we're seeing as fraud, financial crime, authentication, all of these things is really one of convergence. And that says that all of the words that are on this screen are things that we do to mitigate risk and protect our customers and protect the bank. But each of them often rely on exactly the same data assets and similar technology footprints. They often may differ in terms of the expertise or some of the process that we ensue, but they still follow a very similar approach many of the times and are completely interconnected. And so living in this new world where traditionally each of these words may have had their own solution or their own team, things are needing to be brought together. And we see examples of that in different markets with banks creating fusion centers or cross-combined teams, or even as far as centralizing these teams under risk within the bank. And there's some good reasons for that, because it's really one of saying, well, the approach we need to solve for fraud and authentication and financial crime is a multi-layered approach. And that means that we rely on a suite of controls, everything from identity verification to identity proofing to understanding aspects around the customer's device and where it is and the risks associated with that. Managing the risk of an applicant when they're applying for the first time, as well as sort of dynamically being able to authenticate them once they have become a customer, ensuring that the people that we do business with are not on a sanctions list or that their patterns of money movement don't need to be reported to a government agency, as well as the aspect of transactional fraud. And really, when we look at this, it's about taking the intelligence and the insight from one layer of the control and making it available to another layer of your control framework to make better decisions. So I can make a smarter decision around, should I step you up from an authentication standpoint? If I had more insight as to your identity, your recent transactional behavior, and do you represent a regulatory risk as an example? So this is very much an approach that I think the modern, both fintech and digital oriented banks are looking to take. And so the main aspect around this is one of saying, map those controls across the stages of the customer lifecycle and understand how different combinations of controls leverage similar data assets, require similar intelligence, could do with greater efficiencies if multiple teams were combined to initiate a common set of controls, as an example. And so as we move across that customer lifecycle, we find that there are different combinations of these layers that come together. As an example, we typically want to ensure that our KYC, as well as our sanction screening and our AML controls, which can often be distinct teams, can actually leverage common componentry, can leverage common data, and have interconnected processes. The same is true, for example, when we onboard a client, the need to ensure, especially for things like eKYC, as well as identity proofing and mitigating the risk of application fraud, whether it be first party or third party. So it's really one of putting the customer, as you can see, really at the center of this and understanding which of the different controls I'm looking to invoke at that sort of customer level. And then once they have become a customer, I have to constantly cycle between this aspect of proving who you are, your identity, authenticating you when you're accessing your account, and making sure that it is always you who is touching your account, and that it isn't somebody that is a fraudster that has access to your credentials and is looking to take over your account. And so to be able to solve for that, we have to combine aspects of authentication data and transactional data and non-monetary events in order to prove whether the customer is legitimate in the actions, or is it somebody pretending to be them. And again, most of the new faster payment type peer-to-peer transactions that are real-time, again, have that sort of need to be able to, from an account takeover perspective, to be able to balance together the authentication experience with the payment fraud experience. Even, for example, for things like three-domain, from a card perspective, there's the need to balance the experience that happened from an authentication to what happened from the payment fraud perspective. So we don't ask somebody to step up and for example, biometrically authenticate themselves, only to then go decline that transaction because we think it's high scoring and it's potentially fraud on the other side. So it's about ensuring that both of those decisions can share insight. Like if I could make a better authentication decision if I knew about where the card was last transacting and what the risk of the account currently is from a fraud exposure standpoint. If we go along a little bit further here, it's really about saying, how do I solve for the questions I have about the consumer at any moment in time? So that wealth of data leads us to think about questions. Those questions we derive answers from, and those answers are what we call at FICO contextual intelligence. And so it means have the right data at the right time to make the right decision. And so in that world of convergence that we talked about, it's about being able to derive facts, those answers to those questions, from multiple different data assets, be able to orchestrate them together and be able to build predictive variables or context, which are really those answers we talked about. So for example, there are lots of questions we have around the customer. When did they last do KYC? Have they ever done a faster payment before? Is the customer enrolled in bill pay? How much did they last deposit in their account? How far are they from where they last used the card at an ATM or POS, for example? And so as we build up the context around these customers, it's really about thinking about these questions, like when did they last access their account? Have there been any failed login attempts? How many payees are set up for this customer? And so we keep building them. And if you think about what we're doing here, we're really creating facts around different assets of that customer. The account, their email, the mobile they have, the device they're using, the multiple devices they're using, the biometrics that they have perhaps provided to us. And it's only really when we have the answers to all these questions that we're really able to make a much better decision around whether we pass or fail, whether we approve or decline, whether we step up, authenticate, or let somebody continue to touch their account. And so to balance that fraud and customer experience, the best thing to do is to think about how do I create an orchestration capability that allows me to move the intelligence that I have and make it available to the different decisions that I might need to make, whether they're applying for a new product, they're expanding the relationship with the bank, whether they're changing their mobile phone or they've moved to a new location. The better we understand the customer's behavior, the better we can only provide the fraud control when necessarily, but at the same time improve our chances of minimizing friction, improving revenue, and driving up that customer experience. And that mainly is the summary here of why it makes sense to take this kind of converged approach to fraud and financial crime. You can ensure a more consistent customer experience across the channels. We can bring down those fraud losses or reduce our exposure. We want to maximize the ability for the bank to generate revenue. and do that with some level of economies of scale. So it makes no sense for 5 or 6 different fraud or financial teams to each create a set of these answers. So they're all creating the same variables, like when did the account get opened and how long has it been since somebody last accessed the account. It makes no sense to keep duplicating this approach to variables when that can be consolidated. And in doing so, I can also optimize, because it's not only about your own data, but it's about data that you need to pull in from the outside. So device intelligence, stuff from the dark web, regulatory watch lists, biometric data. But then you're only really consuming that data when it's pertinent to making the right decision, and not just consuming it all the time because it's the latest, greatest kind of data that come in. And what that really does is it helps you to sort of manage that sort of total cost of ownership. So I think there's some strong benefits across the board here to why taking a converged approach to fraud in this day and age makes sense. So thank you very much for your time today and for taking time out of your schedule to listen to the topic. And if you're willing to stay around and you have some questions, we'd be willing to answer those. So thank you very much. Back to you, Vicky. Thank you very much for your time today. I hope you found this session informative. We've had a few questions come in here, so I'm going to take a bit of time now. We've got 5 minutes to answer a few questions. Feel free to ask any other questions in the chat window there. So the first question that we have is, how is FICO reducing the gap between technology, fraud, services, and the demand KYC? So I think the question's a really good one. Everything we do from fraud is about blending together people, process, data, and technologies. And everything that we need to do in a digital environment pretty much means that all of that data and technology needs to work in 100% real time. And then when we look at what we need that technology to do, as I touched on in the presentation, you have to be able to orchestrate intelligence around the decisions you make across the customer lifecycle. You need to build up the context around the customer's behavior. And more importantly, you need to profile that behavior at a customer level, not an individual product or channel level. And the next thing is the people. So it's great to have fantastic data available in real time with amazing technology that can help you make good decisions, but you've got to be able to make the operational execution of fraud simple. So that means enabling a single view of the customer, deploying technology that can facilitate more efficiency, like robotic process automation, being able to engage with consumers and confirm transactions in a multi-channel way such that you can automate the working of fraud cases, as an example. So those are some of the things that we do at FICO here, both in our technology and sort of enabling the efficiency of the operational activities of fraud. So hopefully that answered your question there. Next question we have on the list is, which part of the process in a transaction needs more attention in order to prevent a fraud? Data, payment, authentication. So I would really say that it's actually about creating a balance between the fraud and the authentication decision. So a bit like at the end of the presentation, it's really about having the right data at the right time for the right decision. So if I make authentication decisions without using recent payment information or payment transactions, my authentication decision won't be as good. If I make a authorization decision, but I don't understand what happened from the authentication prior to that, whether it would be an Apple Pay registration, provisioning a new card, whether it be a 3-domain secure card transaction, whether it's accessing online or mobile accounts, we have to ensure a balance between the step up and friction that we did for authentication and the decisions we make on fraud. So if somebody biometrically authenticates themselves and then we go decline the card transaction, it creates a bad customer experience. So I don't think it's one is more favorable than the other. It's really about making the intelligence between these traditionally siloed business areas come together so that you can do more predictive decisioning. The next question we have here is, do you think prevention should have less requirements? Of course, prevention is the best way to reduce losses, but it's impossible to 100% prevent fraud. Otherwise, we wouldn't have any customers. So, prevention can be bad because it can mean customer friction. So like we mentioned, I could have to step you up, make you do something, or I decline your transaction. So again, it's a balance, right? When we take an action, a prevention action, we have to think about what of that control can be done passively without the customer understanding what happened, and what can be done from an active perspective. So again, it's about balancing that experience. But equally, customers like to feel like they're protected. So stepping up somebody to something they feel is trustworthy, or having a way to communicate and validate transactions with them is actually often a moment of truth for customers. They feel protected by their bank. So yeah, I think prevention's very important, but again, all the controls across the fraud lifecycle need to be balanced. I think we've run out of time now, so thank you very much for your questions, and I look forward to speaking to you again in the future.
Thank you, Adam Davies. This was very relevant information for all of our audience.